And hi, everybody, and welcome to the Mental Toughness and Body Show. My name is Rob Evans, and I'm your transformation coach, health strategist, and internationally published author, helping take your life and your business, your health, fitness, mindset, and body from where it is that you are right now to where it is that you want to be. And I am joined today with Gil Baumgarten he's the president of Segment Wealth Managers based in the US. Gil, thank you for joining me today.
Glad to be here. Thanks for having me.
So, Gil, you have a lot of experience, about 38 years from what I picked up on your profile in the financial advisory business. Maybe just tell us a little bit about your background and what brought you to starting Segment Wealth Management.
You know, I was in the brokerage business for 25 years. I worked for UBS and Smith Barney before that, and learned a lot about investors and investing and how stocks and bonds work and various products like mutual funds and the like. And I just saw investors make a lot of mistakes, and I saw the brokerage firms try to line their pockets from some of those mistakes and some bad habits that people had that the brokerage firms, I thought, encouraged them to make even more mistakes. So I decided to go a different route and leave the brokerage industry, take my clients with me, and then, grow a fiduciary type of advice business where I could be more of an advocate for clients making good decisions as opposed to me marketing to them, which is essentially in the US, how the brokerage business operates.
So we've probably got some differences between how advisors work in the US and Australia, but fundamentally the same. One of the things I picked up from you is that you're a fee-based advisory service. So could you maybe just talk to us a little bit about that? So, maybe someone is watching this for the first time and they don't necessarily have a financial advisor right now. I think that's an awesome model, but tell us why you've set it up that way.
Well, when I get paid the same way, no matter what you do, the type of advice that a client is going to get from me is very different than if the client walks in and I can make 2% if they do this, I can make 1% if they do that. And it's in many cases like a big buffet. Yeah. And when you're in the brokerage business, especially when you first start out, you really kind of focus on the high commission products because clients are hard to come by. And if you have a willing suspect there in front of you, you're going to spend your time on the 4% products and not the 1% products. And that's the reason why in the US, annuities, for example, and life insurance type products get pitched a lot because they are very high commission earning products. And you don't have to have as many customers. You don't have as many people to say yes to earn a living doing it. But after you've been doing it for a decade, you kind of see the treachery in that. And after you've been doing it for 20 or 30 years, you really get to a point of indifference where, I don't really care what you do. I'm gonna be able to make my living one way or another without having to direct clients in a particular way. And once you can become agnostic in the way you give advice, the way that comes across is much more thoughtful and much more problem solving with regard to the way people perceive it. And therefore, they trust you a whole lot more. And that's the reason why I believe that my business has grown by 500% since I started the business just 13 years ago. I left UBS and took maybe $250 million worth of client money with me. And today, it's a solo practitioner firm. I have 8 employees, but I'm the only advisor. We have $1.3 billion worth of client money. Wow. And I think that's a direct relationship to how truthful people could tell that I was and how indifferent I was to the way I solve their problems and the guidance that I give them accordingly.
Yeah, brilliant. Brilliant. I think it's a huge red flag if you go and see someone and they say they're commission-based, they just run away from that person. So one of the things that I've personally noticed is with the financial advisor that I've used, it's the fastest way to build wealth. If you've got somebody, because you just don't know everything, you go on doing your thing and you don't necessarily understand all the ins and outs of particularly tax, what's the appropriate tax strategy and so forth. I'm assuming that you would concur with that. The fastest way to go from I suppose, where you are to where you want to be financially is you've got to get, I would say, early intervention with the financial advisor and get on the right path as fast as possible.
Well, the typical investor is going to go through many iterations of themselves. The first thing that they're going to do is they're going to want to really get on the fast track, because somebody who's 30 or 40 years old, who's just getting started, kind of looks at the end of the line and goes, well, I got 25 years left to go. If path A is going to produce a 8% rate of return, and trading Bitcoin or whatever other craziness can produce these 100% rates of return, just think about how far down the road I can get if I have some early success. Well, they end up getting spanked a time or two by trading stocks or trading Bitcoin or doing crazy things. They get bit by the taxes. And so it's really a matter of just the surviving philosophy is all the things that you've already eliminated because of how bad your experience was. Those things get pushed out of the mix, and you find the person is then 10 years older and then is really just getting started because it took them a decade to figure out what not to do. Back to your point, they would have been way better off to have hired a financial advisor to sort of show them the ropes and tell them about the mistakes that they were going to make and help them anticipate that and get them further down the road. That's predominantly where the value is, and being a repository for the worry that a client would otherwise bear upon themselves, and the fear and trembling and trepidation that they would approach with each decision, where somebody like me is much more understanding of the outcomes and is not going to tiptoe my way through the portfolio construction process like a typical neophyte investor would.
Yes. Yeah. Great points. What would you say is some of the common mistakes that people make to prevent them building that long-term wealth?
Buying sexy returns as opposed to consistent returns. I could easily, I'm going to speak from a point of US taxation. I don't really understand where yours or how everybody else's domicile is going to affect it. But I promise you, this is how the math works. Under optimal tax circumstances, I could produce an 8% rate of return and have my $10,000 investment turn into $1 million in a 30-year time period and be completely tax-free to me. Under the same scenario, you could have the worst possible fee and tax outcome. Let's say it's short-term capital gains and you're in a hedge fund with a 2% management fee and they take 20% of your profits. Sexy nonetheless. It would take a 22% rate of return from your hedge fund to match the same dollars I'm going to have from my 8% rate of return after fees and after taxes. And many people will look at a hedge fund and go, well, look at these fantastic 18 or 19% returns, which are quite inconsistent, by the way, and they have no concept that that's before fees and before taxes, and that plotting in a simple 8% rate of return is going to produce much more money over a long time period. It's those types of simple mathematics gymnastics that people get deceived by and end up with a very poor pattern of behavior that they could have chosen a different outcome.
Yes, great points. What would you say you see as the impact of the introduction of artificial intelligence, robo advisors, and that kind of thing that is starting to come along now? How do you see that impacting your business and the industry?
Alternative, AI in general will produce some very powerful tools for somebody like me to scale their business. Imagine if I could just simply have the concept of, I think I should swap my NVIDIA shares for Microsoft shares. What would be the tax impact across my 1,100 account numbers to make that swap? And AI would allow me to quickly sort through all of my accounts and figure out how all of that is going to work for me. We already own software that allows us to sort by a lot of that, but the modeling capability would be very simple for me to take alternative, AI and turn it into a much more powerful tool. So with regard to robo advising, the likelihood that you're going to trust a algorithm that you don't really understand how it's being built, and you're going to subscribe to a service that tries to define that down for you, you're going to find not very many very sophisticated investors are going to go that route. It's already starting to show up in the US when advising has been a thing for a decade now, and you have companies like Betterment and the like that are really having some difficulties. And as a matter of fact, several of those businesses have been sold at fire sale prices because they just can't build enough scale, and
Right.
they end up with very small accounts. And frankly, the fees on that type of service can be 25 or 30 basis points, which would be very low. My average fee for a full service wealth management practice is only 56 basis points. So 0.56 is what we charge our typical client, which is really not that much more than a total do-it-yourself algorithmic, non-tax centric way of doing things. So I just think people are going to trust an individual advisor more. They're going to trust some black box,
You'd hope so.
especially when the price differential is not that great.
Yeah. Great points. So, so on this show, we like to talk. I'm really interested about, people's personal journeys and, mental toughness, and like I mean, we're probably not that different in age. We've gone through a lot of different things, COVID recently, what's happening in the economy at the moment. What would you say are some of the most significant challenges that you've faced over the past 38 years or so in your career and in business?
Well, I would say that, to go back a little bit further, part of the reason why I chose to get into the financial advising business is the difficulties I had as a teenager. My parents were divorced when I was 10. My mom's car got repossessed. We just had typical single parent issues from a difficult situation with my mom and my dad. And that sort of motivated me to figure out how money worked. I
Yeah.
went to a public high school here in town that was right in the middle of one of the wealthiest areas of Houston, although I did not grow up in that area. And I made a lot of friends, and I saw their parents and how they lived their lives. And I thought, this money thing is something that I need to learn about.
Yeah.
And so financial trauma as a teenager is the number one indication in the US of a precursor to somebody being successful in the financial advisory business.
Right.
I learned that by way of having worked at E.F. Hutton and having done a study for my firm, interviewing the top 100 advisors at the firm about how, where they came from. And that was one of the things that I found most revealing. And it was true of my life too. And so, but with regard to my career, the things that are most difficult for me to stomach are times of super high volatility, like the 2000 market crash, the 2008 market crash. The stock market in 2008, 2009 lost 58% of its market value in 15. If you were invested fully in stocks, you only had 42 cents on the dollar left. If you had liquidated, you still would not be even. But if you had stuck it out, you would have been even within 6 years. And then by the 10th year, you would have doubled your money. And so the best rates of return are normally found right on the heels of the worst rates of return. And you really have to stick it out and endure it in order to benefit from that. That happens to also coincide with good tax policy, because long-term unrealized gains are tax-free at death here in the U.S. So if I have a $1 million investment that's, $3 million 20 or 30 years later, if I haven't sold those investments and then I pass away, my family inherits that from me without ever having to pay any capital gains taxes.
Yes.
So that's an important part of the philosophy of how to think about how to compound wealth. But that's the answer to your question with regard to the challenging things that I've endured.
What were you in the industry in 87?
I was, yes. I was licensed in June of 85. I went to work for E.F. Hutton in November of 84. So I'll have my 40th anniversary next year.
So was 2008 worse than 87?
Oh, way worse. And the reason why is that the market crash in 87 was 27%, but it occurred in only one day. And within about 6 months, the market had recouped that. Whereas in 2008, the market lost 58% of its market value, and it
Yeah.
took 15 months. It was just really devastating. But if you had invested your money in 2008, 2009, you would have really had some spectacular rates of return on the heels of that. It's
Yes.
just a difficult lesson to learn for the typical investor. And that's the reason why people tend to chase investments around. They want whatever the hot dot is.
Yeah.
They want whatever, they really only want to do what they should have done a year ago.
Yeah.
And the problem is you'll end up chasing your tail, and you'll end up only serving up the worst of what the market has to offer you if you do it that way.
I love what you said about from your teenage years. I was the same. My mum and dad had very poor monetary mindsets. I mean, when you're a kid, you just ask for things, or there's food there. I mean, you don't even have a perception of money really. But as I got older, I realized that they never really had any of it. They really struggled. Mum didn't work and dad didn't have a great wage.
Yep.
And that's what motivated me to not be like that.
Yeah, me too. I learned some really bad lessons from my dad. He grew up from a divorced family and kind of raised himself on the streets of Galveston. So I don't know if your audience knows where that is, but it's a suburb of Houston down on the coast, and it's like a shipping community, and it has had some riffraff and some other issues. Back in the 20s and 30s, there was a lot of mafia and gangster activity down there.
Okay.
It was just kind of a tough place to grow up. And my dad grew up basically shooting dice on the streets of Galveston when he was a teenager, and never really learned any good habits from his father, and
Yes.
sort of grew up sort of feral, sort of wild, and just never really developed a lot of good money discipline or discipline in his life in general. And he took a lot of shortcuts in the way he lived his life, and was very self-centered as a byproduct of that. And when in my younger years, I learned some of those lessons and was kind of self-centered myself, but I saw how much misery came from that, not only in my own life, but how I inflicted that upon others. And I decided to stop doing whatever I learned from my dad and start doing it a different way. That was in my 20s by that point in time. And then I realized that if I could be the total opposite, people would really trust me. And if I could give them good advice, I could actually make a pretty decent living as a trustworthy advisor. So I really kind of completely changed my stripes in my 20s and learned a lot from my bad habits and my parents' bad habits.
Yeah, nice. What would you say has been your greatest failure? And what you learned from that?
Oh my gosh, my greatest failure. Probably learning those lessons too late in life. If I could have learned those lessons when I was a teenager, I would have had a different outcome earlier in life. So I would say that's probably my biggest failure. And I think failure to manage my career properly. I probably would have made more aggressive decisions in my career earlier in life. After I had kids and had them, financially, me being financially responsible for them really kind of took away my sense of risk appetite. And I stayed in my brokerage situation far longer than I should have. I should have had an increased risk appetite, and I should have managed my career more aggressively. So that too would be a failing.
Yeah, nicely said. Yeah, I agree with those from my own perspective. If you were talking to somebody that's either just starting out as an entrepreneur, for instance, what would you say are some of the, it doesn't have to be just starting out, could be just like me right now. What would be some of the things that you would say, maybe 2-3 tips that you would say absolutely essential for success?
Well, taking risk and being well capitalized. So part of my risk appetite came from the fact that I was pretty well financially set when I started my own business when I was 50. I would have been way better off to have done it when I was 40, because I already knew enough about the industry to have parlayed that and transitioned earlier. I think I would have been better off. But to be well capitalized, a lot of that just comes from the same lessons you learn in investing, is you have to have a willingness to lose. If you venture into investing and you don't have a willingness to watch your money go down in market value, you'll only stick around until it goes down in market value, and then you're going to liquidate. So that means the only outcome you're going to experience eventually is a loss. because then you're going to liquidate and you're not going to enjoy the rebound. So you really have to teach yourself how to have a risk appetite, have a willingness to endure loss. And that just comes from a lot of soul searching and just, I guess, positive reinforcement that is in fact the way to generate, better returns and better outcomes over time, is just having a willingness to lose.
Yeah, sure. Another tip that you would perhaps give for success? Well,
You know,
some
I would
mindset
say
stuff. So obviously, sorry to interrupt. You've obviously gone through, a lot of different challenging markets and so forth, and your own sort of grit and resilience is quite strong. What would be something that you could say to people how you can develop that? Because I see in our kids that we're not really developing a really resilient generation that's following it. So how would you help people develop it?
it is very difficult to develop it on your own. It is so much better for it to have been done by a parent. You really have to stress test your own children. My children grew up relatively affluent, and I made it deliberately difficult for them to make sure that they had some tough situations, which is difficult to produce unless you're deliberate about it. My 16-year-old son always thought that he was the master of his universe. And by the time he was 17, he had already crashed the car a couple of times. And I made him feel the pain of that. I made him get a summer job. He did $600 worth of damage to our family car because he just wasn't paying attention when he was a teenager. And I made him get a summer job. And then
Pay for
when
it.
he earned his first $600, I had him show it to me, and I snatched it out of his hand and told him that he was paying for the damage he had done to the car. And he learned some very difficult lessons from that. And so you have to create situations where you're testing the resilience of your children. It's much more difficult to impose that upon yourself without a lot of introspection. And really, you're just going to have to kind of learn what grit and resilience looks like and try to model that. You can also learn it from other people by watching their behaviors. You can subscribe to a lot of Warren Buffett channels. He gives really good advice about developing grit and resilience and things that he's learned, and little, tips and words of wisdom. And frankly, I write about it a lot. People can subscribe to my blog, and they can, subscribe to that. And we write about patterns of behavior and psychological investing, and then just how taxes work and how investments work, sort of an expose on various ways of looking at investments and money. So that would be another way to do it. Or read my book. There's some topics in there that are along these same lines.
Yeah, well, actually, now that you've just mentioned your book, let's give it a plug. So it's called Foolish: How Investors Get Worked Up and Worked Over by the System. And tell us a little bit about it and how people can grab a copy.
Yeah, so it's on Amazon. It's also on Audible. I did the author read version, so you can listen to me drone on for about 4 hours as I read the thing. But the first third of the book is really about how the brokerage industry operates in the U.S. and the little dark corners where they make money, and they have little gotchas that you would never be able to figure out on your own. They don't adequately disclose where these little gotchas are. And so we sort of have a little expose on how many of those things work, how the ecosystem is built. But then the back 2/3 of the book is really about the bad habits that people develop. They don't have grit, they don't have resilience, they can't bounce back. They play these little mental accounting games where they try to put themselves in a position where they can brag to all their friends about how smart they are, while they're hiding that from those same friends all the failures that they've had. So there's all these ego things that we do, and bad reinforcing patterns of behavior, which if you were much more objective about the way you looked at your world and your pattern of behavior in the past, you would have been much more critical with it. And so there's some tips in there about how to, think about things. And so that's really what the back 2/3 of the book is, the psychology of successful investing and getting away from bad habits.
Yeah, excellent. I mean, and so much of what we do in success, and it doesn't really matter the industry, it's around the mindset. I'm a bit obsessed with high performance outcomes. And I mean, whether it's a high performance business person or high performance sports, the principles remain the same, and how
Yes.
you remain mentally tough, and the difference between, well, tennis is probably a good example. You've got, it's 40 love and the other person's about to win the game. It comes down to, if you've given up in that point, you will not win. You will not win accidentally.
Yeah.
The only way that you're going to win is if you believe that you can win. And it's those same principles that apply to everything in life. And it's the only way that we can, move to that next level.
Yeah, and along those same lines, a lot of people don't think this way, but if you think about the stock market, for example, if you looked at all the 12-month time periods, January to December, February to January, you look at all the rolling 12-month time periods for the past 75 years, those rolling 12-month time periods produce a positive rate of return in 81% of all circumstances.
Yeah, wow.
If you were ever to go to Las Vegas and run across a slot machine that paid off 81% of the time, you would never leave that slot machine, and you would never stop plugging quarters into it.
Yeah.
And the same concept needs to be understood by people who invest in stocks. It's not a matter of going out and trying to pick some hot stock and seeing how you do, or buying 2 or 3 tips from your buddies and seeing how you do. Build a diversified portfolio, and those 81% of the time is going to pay off for you, is what the lesson is to be learned from that. And if you keep your fees and taxes low, your returns are going to be even better. So I would just say, plug a lot of quarters into the machine.
Yeah, such great advice. I've got 2 more questions for you. What would you say is the best advice that you've ever received?
Oh, I guess about keeping my debts low, and not leveraging anything that depreciates in market value. Buying a car on credit is a really bad idea.
Yes.
You're really better off by paying cash for a car and then begin to save for your next car. And then after your car wears out, after 5 or 6 years, pay cash for the next car, as opposed to trying to go out with very little money and trying to buy the $50,000 car that you have to put on credit. Well, you're going to end up paying $75,000 or $80,000 for that car.
Yes.
Now compare that to buying a house on credit, where you get $50,000 as a down payment, and you go out and finance, $500,000 to buy a house at a much lower interest rate. And in the U.S., that interest that you pay is also tax deductible within certain limits. But that house is more than likely going to appreciate over time.
Yes.
So you're going to experience the appreciation on a $500,000 investment, only putting $50,000 on the table and taking a tax deduction for the interest that you paid during those years that it takes to experience that. Now, that's an investment that I can get behind, is borrowing money for that. Borrowing money to buy a car, if you're going to turn it into an Uber, I can get behind that. Or borrowing money to, buy a rent house, or so leverage is one of those things that is not a bad word, unless you're using it for consumption in some way, and buying a car on credit or taking a vacation on credit. Those types of things I would consider to be very bad habits, and that's one of the pieces of advice that I got when I was younger, is don't ever borrow money for anything that's going to go down in value.
Yeah, that is great advice. I don't know whether you can do it in the US, but here, like that car scenario, people can add a car loan to their mortgage, and mortgages, I think the highest one's like 32 years now. So people can be paying off that car for 32 years, and they think, oh yeah, no, it's only, like you said, $50,000. Really? Do you want to do the sums as to how much that's actually costing you? And you've probably changed cars five times in that time.
You're not allowed to do that here in the U.S. You're only allowed to collateralize real estate that way. So no, I think that would be a very bad thing to do, to be adding a car. 30 years from now, you're going to be paying for 5 cars ago, for 4 cars ago, 6 cars ago. That sounds like a conspiracy by the banking business.
Yeah, yes. Listen, you've added so much value here today. It's been really great. We can keep talking, but if people want to get in touch with you, now I know that a caveat, you only do work in the US, but we do have a US audience. But that's right, isn't it? You only work with US clients.
Pretty much, yes.
Yeah. So how can people get in touch?
They can email me, gil.baumgarten@segmentwm.com. So Gil is spelled with one L. You can Google me and find all kinds of podcasts and other things that I've been on. They can subscribe to my blog. I'm never going to call anybody. We don't sell your list. I'm not doing it as a way to find you and market to you. We don't operate like that. Sign up for our blog. You'll get posts whenever we send them out about tax advice or investing or whatever. Buy my book if you like on Target or on Amazon or wherever you want to find it. But that would be a way to get information, or you can just email me at my email address, which you can find on my Segment Wealth Management.
I'll add it, but I'll add your contact details below the podcast post here, so that people can find you there. Yeah, look, I think it's really admirable the how you want to give back to the service that you do to provide people just more advice in this really, really tricky space where people, I think, become so scared of it. And you're right that people, the younger generation, they'll dabble with some mates and stuff, but they need this long-term strategy that they can know with confidence that I can sleep at night. I know that you're getting your 8% or whatever, and you're building this wealth for the future. So I really love what you're doing in that space, and your approach being only fee-based and everything. So thank you so much for your time today, Gil. It's been an absolute treat talking to you.
You too. Thanks for having me.
Thank you.